Hi, good afternoon, friends, and welcome to CareEdge webinar on cut and polished diamond industry. War casts shadow over glittering diamond industry. I am Yogesh Shah, Director Ratings and Head for the rest of Maharashtra region and the host for today's session. We have today with us some of the best minds from the industry to discuss the subject and place their perspective before us. I would like to introduce you to our esteemed panelists, Mr. Raj Gopalan Kuravai and Mr. Basant Kumar Das. The session will be moderated by my colleague Yogesh Shah. He is a senior director at Care Ratings, has a total experience of over 20 years in the ratings industry across corporate and ratings. A very warm welcome to all the esteemed panelists and thank you for joining us today. Now for a few preliminary remarks on today's theme. The key takeaways. The Indian cut and polished diamond industry posted robust growth with polished diamond exports reaching USD 24.2 billion in FY22, surpassing the pre-COVID levels of USD 23.8 billion reported in FY19, the pre-COVID year. USA was the major demand driver, followed by China and other European countries. The demand was fueled by lack of experience-based traveling, value investment, and stimulus packages. However, macro headwinds are reflected with Russia's invasion of Ukraine in February 2022, former being major supplier of rough diamonds. Sanctions imposed by the US and other diamond jewelry markets are expected to intensify the scarcity of certain categories of diamonds for which Uldrasa has been a dominant market share. Further intermittent lockdown in China-Taiwan geopolitical risks weigh on the sector. Alternatively, lab-grown diamond segment is exhibiting strong performance with growing acceptability on account of technological advancements, affordability, ethical and environment-friendly mechanisms. In FY22, the lab-grown diamond export has reached to about INR 100 billion in the last financial year, growing at a CAGR of 84% since FY19. All this being critical to the growth of the sector leads to a few pertinent questions. How will the CPD diamond and margins play out in the medium term? Evaluation of digital channels and the way forward. Will LGD be a good alternative to natural diamonds? And what about funding to the sector? CareEdge Ratings, with its prominent position in ratings of cut and polished sector, has assessed its CPD sector portfolio to provide insights on their performance, challenges, and outlook through today's presentation. It will be followed by a panel discussion. Thereafter, we shall have a Q&A session where the participants can key in their questions in the slot provided on their panel. Kindly specify if the question is directed to any panelist. But before that, we shall begin with CARE's presentation on the CPD industry. I request my colleague Ujjwal Patel to present CARE Ratings insights and outlook for the sector. Ujjwal is an associate director and sector specialist for gems and jewelry sector at CARE Ratings. Thank you. Over to you, Ujjwal.
Yeah, thank you, Divyesh. And a warm welcome to all of you in this webinar. So as Divyesh pointed out, we shall be discussing all the key aspects in the sector. And the presentation is divided in 3 sections. We will start with the natural diamonds, where we will be discussing the changes in the CPD value chain post-COVID-19, global demand statistics for the diamond jewelry as well as the cut and polished diamonds, Russia's and Uldrasa's share in the rough diamond market and how it has impacted post the Russian invasion of Ukraine on the CPD value chain. And finally, how does the India's natural cut and polished diamond export statistics looks like in the past. The second section covers a brief about the emergence of lab-grown diamonds as a diverse segment and India's lab-grown diamond export statistics and how does the way forward look like. And finally, we should look into the key performance of key players in the CPD segment, our outlook and the rating history and MCRs for the sector. So beginning with the first sectors on natural diamonds, we have a 3 main value chain analysis, right? So, and diamond industry has largely been a physical industry, starting with manual inspection of rough diamonds by site holders and alliance members, attending diamond trade shows across the globe, and finally the retail jewelry sales, wherein less than 10% of the diamond jewelry sales was conducted online. Travel restrictions due to coronavirus pandemic and various degrees of extent of lockdown mandated focus on development of online channels not only by the miners, but for the upstream and downstream segment as well. It was a new reality to adapt to new normalcy on the backdrop of lower global demand. We saw major mining companies allowing deferment of allocations to site holders, focused on direct sales to large polished manufacturers and integrated resellers. This period also saw focus on beneficiation and mine-to-market partnerships overall, and supply remained constrained with a very specific focus of miners and adoption of price over volume strategy as the operations picked up and their intention to avoid speculative movements. In the absence of any physical travel to India by major buyers and vice versa, the midstream also developed a direct-to-customer sales channels with major focus of large organized CPD players on certified diamonds. Most of the CPD players have developed proprietary online platforms apart from the developed online platforms available across and which has resulted in a leaner collection period and its working capital cycle. The segment also focused during this period on improvement of efficiency and adoption of conservative financing policies. Looking at the upstream segment, retailers saw more tractions on their website as online sales gained momentum, and considering travel restrictions in place, localization of consumption increased during last 2 years. More so, it was not only restricted to organized retailers, but even small mom and pop stores invested in technology to offer a better customer experience by reinventing the purchase experience through a mix of physical and online channels. Nevertheless, currently we are seeing higher investment by organized retailers in expanding their market reach by opening new stores, especially in China. In a nutshell, we can brief it that coronavirus pandemic mandated realignment of the entire value chain, adopt digital channels in sharp contrast to earliest modus operandi, and focus on value addition for customers at each stage. Looking at the global diamond jewelry demand as well as the polished diamond jewelry market, it remains stable as reflected in the graph for CY17 to CY19, with a contraction in FY20 by around 14%, primarily due to US-China trade wars, political unrest in Hong Kong. This was the period where we felt like the sector is slowly moving towards a negative end and supported by a dip in demand for cut and polished diamonds. Rough diamond sale by miners, on the other hand, saw a steeper decline. The revival in demand in 2021, as reflected, was much faster than expected and exceeded the pre-COVID levels of 2019. Global diamond jewelry as well as cut and polished diamonds demand increased by 29% in 2021. And considering India is the largest processing center, overall exports of CPD also rebounded significantly by 49% to $24 billion in US dollar terms. Robust recovery in demand, which was initially thought to be a pent-up demand, remained steady as the holiday season approached, supported by fiscal stimulus programs by the government in key consuming nations. In terms of countries, actually, USA continued to be a major market for diamond jewelry with more than 50% market share, followed by China at roughly around 10 to 11% and India at 6 to 8%. Nevertheless, this trend of recovery was consistent with what we have seen in the past in earlier economic downturns or crisis faced earlier, wherein the diamond industry reported high double-digit growth within a calendar year or two after the crisis peaked. This was seen observed in the current crisis in the current period of 2021 also. If we look at the operations of Indian entities, so the midstream segment dominated by Indian entities reflected a mirror image of the industry performance post-COVID, marked by steady increase in overall exports since Q2 of FY91. Over and above the fiscal stimulus or other overstimulation of the economy, a lack of alternatives in terms of other luxury spending, experience-based activities, traveling, and easier access to diamonds through online channels made it a preferred choice for customers which had an excess liquidity due to reduction in overall expenditure. More so, reduction in unemployment rates and driving up of vaccinations in the second half of the financial year resulted in faster than recovery and inventory turnover than what we had reported in the previous year. For Indian entities, it resulted in a faster inventory turnover and earlier than usual orders for depleted inventories. More so, it also ended a prolonged state of decline in cut and polished diamond prices, which was reflected for over 2 years. Since Q2 and FY21, as reflected in the graph, cut and polished diamond prices have increased quarter on quarter for over 7 quarters till Q4 of FY22. Contrary to the expectations of softening in rough diamond prices after the Diwali break in November 2021, the prices was even higher and touched a decade high of in March 2022, even after the USA-Ukraine war. However, when we refer to the sales volume line in the graph, we notice a dip from Q3 and FY22. While it was partially because of the Diwali break in November 2021, but in the subsequent quarter, it reflects an imbalance in rough diamond vis-a-vis polished diamond prices. Steep increase in rough diamond prices impaired the pricing parity, and it seemed unsustainable for most of the players in the secondary market. Nevertheless, on an annual basis, exports of CPD rebounded significantly by 49% to USD 24 billion. The overall growth trajectory that has been reported since Q2 of FY21 was curbed to a certain extent in Q1 of FY23 with the Russia-Ukraine war, which consequently led to sanctions on Uldrasa and ban on Russian origin diamonds and lockdown in China. Also in March 22, the US government gave a hint of increase in inflationary pressures by raising the rates, which were stable since 2018. Overall exports in value term, although remained stable at 6.3 billion in Q1 FY23, the sales volume declined by 15% when compared with the Q1 of the same period previous year. July 2022 exports reported a decline of 30% in volume to 21 lakh carats. Imports on rough diamonds, on the other hand, had declined by around 23% during the same period. So going forward, availability of rough diamonds in the backdrop of sanctions of Russian origin diamonds remains a key monitorable for the sector and one of an important aspects along with the other things that we'll discuss in the session going ahead. Before we do that, it is pertinent to note what is the dominance of Russia and Uldrasa in the rough diamond market. The significance of the sanctions is more pertinent considering the dominance they have on rough supply. Russia continued to dominate the rough supply, accounting for about 29% of the global estimate of diamond production in the world. In terms of miners, Uldrasa with an annual production of about 30 million carats, it commands a 28% market share in total rough diamond. However, it commands a higher market share for about 50% in smaller diamond category, that is Mealy diamonds and high color D and F colors, as well as in fluorescence rough, which is particularly used by the US jewelry segment. The Uldrasa, the reason for placing sanctions on Uldrasa is because it is partly owned by the Russian government, and it has been put on a specially designated national list, which effectively places huge sanction to undertake businesses in USA and global diamond market. As sanctions imposed by USA and EU continues, the scarcity of smaller diamonds is expected to intensify, which the other miners may not be able to fulfill in the long term, and hence remains a key monitorable for the industry in the near term. The overall impact on diamond value chain, it remains to be seen, and it may not be applicable only to the midstream segment. The entire industry is on a roller coaster ride with uncertainty across the value chain in the near term. While all the three segments, upstream, midstream, and downstream, reported significant growth in FY22, duration of war, intensity of sanction placed by USA and other nations, the inflationary pressures felt across all the nations and its impact on discretionary spending, even recovery of Chinese economy and their banking system after intermittent lockdowns remains a key monitorable for the industry, as I have discussed this earlier. In the upstream segment, Russia-Ukraine war has altered the supply arrangement from the largest diamond miner. It is more important because consistency of rough diamond supply by the miners is primarily the single stable point for Indian processors, which helps in production planning, working capital, efficiency requirements, and etc. Now, with an uncertainty as to availability of rough diamonds from Uldrasa, availability of rough diamonds at predetermined intervals through sites and Uldrasa alliance gatherings remains a concern. Inadequacy of rough diamonds and lack of demand from CPD, also from China, has forced the entities in the midstream segment to contain their operational activities when compared with a similar period with earlier years. Lockdown in China has resulted in a significant dip in the second largest diamond jewelry market in the world, and inflationary pressures, adverse macroeconomic environment, concerns on the origin of diamonds coupled with geopolitical tensions has been impacting the entities in the downstream segment, to say the least. In a nutshell, to sum it up, I would say there is an uncertainty with respect to demand of cut and polished diamonds. Although Q1 of a financial year is usually a lull period for the diamond jewelry due to summer holidays and robust Q4 and so on, completion of seasons and retailers within depleted inventories. Demand for cut and polished diamonds has been lower than envisaged. USA is reporting improvement in demand after the summer break, but China continues to remain under the pressure due to effects of lockdown. Recovery in demand from these two key nations remains a key monitorable for overall performance of the industry. So apart from demand and considering the Indian CPD entities, which are price takers at both ends of the value chain, one of the most important factor is the pricing parity between rough and polished diamonds. While polished and rough diamond prices both have moderated in the current financial year after peaking in April 22, which was more of an harsh to the war, to invasion of Russia and Ukraine, the drop in rough diamond prices has been proportionately lower than the polished diamond prices. Moreover, polished diamond inventory levels in different segments, although different, but continues to remain high, even more than at the pre-COVID levels. So considering these factors of demand and price parity or lack of price parity, production levels in India has remained low, and most of the entities are cautiously moving ahead with respect to planning of production, sales, and taking into consideration the overall receivables position. So that raises two important questions. Are we seeing an impact of absence of Uldrasa good in the market? The answer is no, not yet. And that is primarily because of the decline in supply is matched by a lower demand. But we believe that the shortage will soon be felt if the war-like situation continues for even next 2 to 3 months. And the second is, what are the consequences of these factors on the employment in Surat? And that is where our second section of Labrum Diamond comes in. The Labrum Diamonds have been around for a decade or so. As compared to other precious stones, it has the same physical properties of natural diamonds and are manufactured either using the CVD or an HPHD technology. While the natural diamond is going through a temporary disruptive phase, green shoots appear on the Labrum diamond segment. With the same physical properties, it has developed a separate and more affordable diamond jewelry. It is developed as a more affordable diamond jewelry category, and it's not mere a substitute for natural diamonds. Moreover, with growing consciousness about the origin of diamond and the impact of mining on natural diamonds on the environment, LGD is being preferred by the set of customer base, more particularly millennials, who have a more inclination towards a sustainable luxury that is perceived to be ethical, free from conflict, and environmentally friendly, and more importantly, affordable. If you look at the LGD exports, it is primarily responsible for the technological evolution that has resulted. It has reduced the capital cost for setting up a unit significantly, and so has the prices. So prices of LGD vis-a-vis the polished diamond has undergone significant change from a discount to a natural price to a cost plus pricing models. To just give a reference, and 1.5 carat round shape, a natural stone, which retails at around $44,500. LGD with a similar specification would retail at around $7,300. This discount has been particularly appeasing to the US market at large, and that is primarily responsible for the growing acceptability in US. It has led to a double-digit growth in production of lab-grown diamonds, which currently is estimated around 7 to 8 million carats. As seen in the graph in contrast to the contraction that we see in lab-grown diamonds in the previous slide, we are having a lab-grown production facilities coming up in multiple countries, of which China is the largest producer, accounting for about 45 to 50% of the total production, mainly using the HPHT technology. Other key hubs, except for Russia, use in CVD technology. So globally, lab-grown diamond jewelry aggregated for about 5.9 million USD in 2021, and is already accounting for 7 to 8% of the total diamond jewelry demand. India, as seen in this graph, is also emerging as a growth source for lab-grown diamonds, and it is the second largest manufacturing base after China. With current challenges and lower activity levels in natural diamonds, few players have earmarked a part of their processing facilities with continuous increase in demand, particularly from USA. It addresses the issues of lower demand of lab-grown diamonds and the employment, and which has helped entities not only to maintain the current strength, but has also generated additional employment opportunities in Surat. As per the industry estimates, and we estimate that lab-grown diamonds were around $3.9 billion business in US, out of which 20% is exported directly from India. India currently has a production of around 1.5 million carats and holds a sizable share in processing of lab-grown diamonds. We can see that growth coming in from FY21 to FY22, where we have crossed almost 1.3 billion USD mark, and it almost doubled in a period of 1 year. And as per our CARE estimate, it continues to hold a strong growth potential in the near term with some caveats on hand. During April to July 2022, India exported polished lab-grown diamonds of around 622 million USD, maintaining the growth of almost 2 times over the same period last year. To summarize this space, we expect the growth momentum to continue in the medium term, with more production units are expected to become operational not only in India but across various geographies. With growing concern on origin, environmental impact, and sustainability, and it being an ethical in nature, we are well placed for growth in the near to medium term. With USA being a major market for lab-grown diamonds and has a better acceptability in fashion space and as an alternative for the natural diamonds to a certain extent, it is now expected to be accepted in other geographies as well in the near to medium term. May not be as high as US. Nevertheless, the caveat here in being that with the increase in production capacity across the globe, average polished lab-grown prices are expected to decline further in the near term. CARE estimates lab-grown diamond jewelry to account for around 8 to 12% of the diamond jewelry market in probably 3 to 4 years' time, with caution with respect to the prices. Covering these 2 segments, this we've already covered with the key takeaways. So covering these 2 segments, start focus on the 3rd segment, that is focus on our experience. So focusing on the micro markets and the operational performance of top 7 entities in the CPD segment, so led by a strong recovery in the demand, the total operating income and profitability of key CPD processors in India had witnessed a robust recovery in FY21 and 22 from the lows of FY20. With direct access to rough diamonds from the miners, scaling up of processing facilities, and faster inventory turnaround, EBITDA margin of this top 7 players has improved to a decade high of almost more than 6% during FY22. However, it is pertinent to know that it is not reflective of the entire industry. This is primarily few integrated entities who have been able to adapt new realities and change business models to changing times, and focused move towards the 30 centers and above certified diamonds. They have witnessed during last 2 to 3 years, which has been a gradual withdrawal from a fragmented small size category to a more organized and certified diamond category, is represented in this sample. We also expect some consolidation in the midstream segment and eventual shrinkage in the secondary market going forward, which face difficulties in sourcing rough at competitive prices, especially after November 21, leading to a stable or marginal drop in TOI during FY22. On the backdrop of recent headwinds faced by the industry, as discussed earlier, it is expected to result in reduction in TOI and profitability by 10% and EBITDA margin by roughly around 90 to 100 BPS respectively in FY23. The key factors that herein being all depends upon the how long the war continues and what is the potential impact even after the war is over with respect to US sanctions in place or the conditions of Uldrasa and how far the rough is available in the market and the consequent demand over it. Nevertheless, considering the debt profile of the entities in the CPD sector, which primarily consists of working capital borrowings, overall leverage and debt metrics are expected to remain stable. That is where the gross credit exposure and our analysis comes in, which for the sector, which relies heavily on working capital borrowing. The gross sector has reduced to around 550 million in FY20 or rather in September 2020 due to collective efforts of the industry and focus on collection efficiency. However, it has reached an all-time high of around 800 billion in March 2022. So we have observed a high correlation between the rough diamond procurement and working capital borrowings in the diamond segment. With reduction in import of rough, overall credit to the sector has reduced in the month of June to 721 billion. To summarize my presentation, I would just highlight the points that the key points remains for the sector and maybe the key monitorables and the lookout factors are the restoration of supply chains and the recovery of customer demand. In totality, both has to happen, or in hindsight or to be a look ahead, both has to happen at the same time. Recovery of demand without rough supply or availability of supply without the consumer demand may not be that great for the CPD sector, at least especially for the Indian CPD sector. So the continuation of Russia-Ukraine war, an extent of sanctions by USA and customer demand in China, there remains a key monitorable. As already mentioned, CPD demand is expected to decline, CPD exports is expected to decline, and it have some impact on the margins also. LGD space, on the other hand, is expected to remain attractive in the near to medium term. Focusing on our migration, so despite COVID-related challenges and primarily being working capital intensive, we never saw or faced any difficulty with respect to debt, the servicing or debt coverage ratios, as it's reflected by more of a retention and upgrade portfolio during FY22 than probably in the downgrade scenario. In the short term, we expect the stable profile to continue, and it will be under monitoring and will keep under watch depending upon the development of the current economic environment. I now request Yogesh to take over the panel discussion, and thank you all for being a patient listener and your time.
Thanks, Ujjwal. Thank you very much for the wonderful and the insightful presentation. So we will be definitely focusing on the key monitorables that we have seen in the presentation today. Before we start the panel discussion, let me first give a brief introduction of our panelists. Definitely, we have representative from both industry as well as the banking side. So let me first introduce our first panelist, Mr. Raj Gopalan. So Mr. K. Raj Gopalan is a non-executive director at the leading CPD player in India, that is Krishna Exports Private Limited. He is a director since 2012 over there, and he has been providing financial services to the Krishna Group since 2007. He holds a degree in MSc in Physics and CAIIB. Also, he is an ex-banker, that is with SBI. He has experience of more than 3 decades. Sir, we really welcome you during this particular webinar.
Thank you.
Yeah, our next panelist is Mr. Basant Kumar Das. So he is heading credit structuring and the portfolio management division at IndusInd Bank. As we are aware, IndusInd Bank is a good, has a major exposure in this particular segment. So his experience as well as the overall knowledge will be definitely helpful in this particular discussion. He has an experience of more than 38 years in the banking sector and is a postgraduate in political science from Bhubaneswar. Sir, we welcome you and look forward to your research-based expert guidance during the panel discussion.
Thank you. Thank you, Yogesh.
So before we start, let me just, as we have seen in the presentation, because so many questions and the thoughts hovering around the key issues pertaining to this sector. So we felt that it's the right time and it's an appropriate time to hold this webinar and get some of the best minds and deliberate these ponderables. So, and definitely these are all very important issues for us in a credit rating agency as well. And we have to continuously assess the credit risk. And with all these developments, the level of complexity has definitely increased. So we are we would definitely be focusing on the key monitorables as being explained in the presentation. I would not like to impose myself on the answers to this question, but I'm sure that we'll have all the excellent expert inputs on this particular platform. So before we start, I would like to inform that all the participants are in a listen-only mode. And may I also request the audience to type in your questions in the box. And please give your name as well as the, you can specify if the question is directed to any of the specific panelists. So I think let us begin. First of all, I would like to have expert views on the current market scenario. So Mr. Raj Gopalan, considering Russia's invasion, especially if we talk about earlier, the thought was that it will not last too long, but now it is almost 6 months of war and still does not see any end. That is one part. Another part that we have seen is the global inflation. So inflation in most of the diamond consuming industries, including US and Europe, the inflation is at a historical high level of 8% and more. Further, there are intermittent lockdowns in the China, and again, the opening of the experience-based spending avenues. So all the 4 factors, if we consider them, what is your view on the demand for the natural diamonds in the near to medium term?
Yes, I do agree that inflation is a worrying factor, especially because of the Ukraine's war, which has, the supply chain of food grains have been affected. And also gas, movement of gas, especially in Europe and, England and other places. So as a result, there has been a problem of, essentials, costing much. As a result, there is an inflation. This inflation will certainly reduce the spending power of the people on luxuries. Especially diamond is a luxury item. So what will happen to the diamond? That is a question mark. But I feel that there will be an impact on the jewelry industry, which uses the small size diamonds more. So far as the big size diamonds are concerned, they are used as investment by people. And this is a very small segment, which is not very much affected by the inflationary trends in the economy. Therefore, I have a feeling that so far if you divide the diamond sector into two parts, small size, which is catering to the, the jewelry, and the big size, which is catering to the investment market. Those people who are involved in manufacture of big size diamonds may not be affected that much by this trend. That is one thing. Of course, jewelry consumption is affected now because of the other avenues for spending opening up. Normalcy is slowly getting restored in the world.
Correct.
So people are enjoying themselves, going on vacations, eating out in hotels and restaurants, etc., and spending on electronic goods, everything. So
Yes.
there will be an impact on the jewelry market, which uses natural diamonds in this. So certainly there will be an impact. That impact to a certain extent will be compensated by the difficulty in availability of small size roughs, roughs that are used for manufacturing small size. Mostly, it is
Okay.
the Uldrasa which has been supplying this. So I personally expect some difficulty in that area. So far as big size diamonds are concerned, I do not expect much of a problem.
Got it.
And the demand is now less during this period. What you observe that there is a lack of demand, the sales have come down. But if you see the American, consumer behavior, there has been an 18% increase in, consumption of luxury items they have spent on it as compared to last year. And so now people are not buying roughs. Whatever existing stock is there, they are disposing it off. So the stock will be slowly coming down. There is a build-up, it will be coming down. Once it comes down, then again, it will pick up, the demand will pick up, or the roughs will pick up, the production will go, it will continue. But this is a type of a seesaw effect which has been going on for long. Every year you will find that between March and August, September, this stock will go on. Again, in November, December, things will be looking up. This is a type of a cyclic thing which keeps on going every year. But inflation is certainly one area which worries, especially in the mid segment, 1 carats, 2 carats, which middle class people and higher middle class people use. There will be some sort of a pressure I am expecting there.
Got it, sir. Sir, I would like to pose one question to Mr. Das, because see, IndusInd Bank has been playing a key role, lending role in this sector. So we have seen the credit exposure to the sector, which has witnessed significant improvement during this recent past. So, sir, how has been the trend post Russia-Ukraine war? Any inputs on that?
Thank you for the question. Let me tell you one thing, that IndusInd Bank is the globally largest lender to this sector, diamond sector.
Correct.
Historically, if you look at the data, the overall credit exposure has reduced over a period of time from 2013 to 2021. It has almost become half. But the exposure is post the fact that industry has grown in terms of volumes over the years. Overall credit exposure can be bifurcated into diamond financing, diamond studded jewelry manufacturing, and gold jewelry financing. Now, most of the international banks have exited from taking exposure from the diamond industry. But that space has been now gradually being taken over by NBA for ENBD. And apart from this, new avenues of financing through securitization process, that is overseas entities of the Indian groups,
Yes.
diamondaires, have gained momentum in recent times through Gift City. But domestic consumption of diamond has increased and financing in Indian domestic market has grown. So still a major chunk of financing is towards gold jewelry, but gradually the diamonds are making slowly space for itself. But post-sanction, if you look at it, the diamond industry is at pinnacle over the last 2 years almost. as far as their business is concerned. So no doubt that initially there was some impact, negative impact. The business was not doing good. We had all apprehensions. The industry had apprehension. The financiers had apprehensions. But that was a short-term this thing. The market behaved differently, and all our apprehensions turned into very positive feelings. It was a feel-good factor that when all our clients or diamantiers they made real good business through online. When the major markets were closed, China was closed, Hong Kong was closed, even US was closed. But subsequently, US reacted very differently through online purchases. So online purchases really sustained the market for some time, and then market revived and rebounds. So the industry has been experiencing a good feel-good factor kind of thing, notwithstanding the fact that there are some disturbances in demand-supply equilibrium issues, but then it has bounced back. That's what is our feeling. And as a financier, we feel happy that yes, we are in the business and we have been supporting the industry all through without having any impairment into the asset quality. And all our clients have been very happy. We also feel happy about them. And we also feel happy about the market.
Yes, great. So you pointed out with respect to the supply side issue. So I would like to take it forward through Mr. Raj Gopalan, sir. So, sir, as we have seen in the presentation also, that Uldrasa is taking nearly 20-25% share in the supply of rough diamonds. And if we talk about the small diamonds, it is a very dominating share. So what are your views with respect to, say, the extent or the tenor of sanctions on Russian origin diamonds and alternative available with the players in the midstream segment, sir?
Actually, I find that, the sanction on Uldrasa is by United States is really not working. So they have banned Uldrasa. You cannot send your remittances to Uldrasa. It is not possible. But the moment Uldrasa realizes that they are not in a position to receive, remittances directly, they start other companies, and through those companies they receive remittances. They give supplies. Supply routes.
Okay.
Supply routes, even though there is, I should say, there should be some 5 or 10% uncertainty is there with regard to supply route. You send the remittance. Whether the material will come or not, a little bit of dhagdhag is there. But I don't think, until now, nothing has happened. The remittances are being sent, the materials are being received, the processing is being done. And another problem is America has imposed, diamonds cut and polished in Russia. No, they cannot be used. There is a problem there. They have banned it. But, Russian origin diamonds, which are the roughs are received by other countries, and they are polishing and supplying, there is no ban on this. So, receiving the Uldrasa diamonds, cutting and polishing them, and selling in the market, it is taking place as usual. So I don't expect that there should be any difficulty in the near future also. Because if they identify, there are 10 companies which Uldrasa has floated and they ban them, Uldrasa will float 11th company, 12th company, and so on, So it is not possible, it is a multi-headed monster type of thing for the Americans. So I don't think they will be able to control it. So long as they are in a position to put the control on the consuming nations, say like India, telling them that if you buy, I will choke you. I don't think that possibility exists now. So because that possibility, if it exists, they have to completely cut down, the consumption of gas in the entire Europe and, in England. England is now facing an uncertainty. They do not know how they are going to face the winter now. They are having a serious problem. So with all these things going on, I don't think that these sanctions are going to work that much in practicality. So people will find a way out for, sending remittances, and Uldrasa will find a way out to send these goods to India and other countries. So that.
So what, sir? So basically, so far as supply is concerned, probably we might have found out certain alternatives. But Mr. Das, can you throw some light, because as we are aware, SWIFT is the only major secure telecommunication platform for the interbank financial transactions. So where SWIFT ban for the Russian banks against the Russian banks by EU and NATO. So currently, what are the alternative options available for the Indian CPD players to make the payments for the Russian diamonds, sir?
Thank you, Yogesh. See, in fact, I was thinking of taking your approval and Rajagopalan sir's approval to supplement the question asked to him. Now that he has answered, let me also quickly give little more supplementary information, saying that the sanctions are bilateral in nature by US and UK and other European nations. India is not a part of that sanction kind of thing. So some of the nations which are not mandated to follow, unless particular entities are multinational obligated to follow those US and UK laws. So Uldrasa has been distributing diamonds through non-sanctioned entities. So there is absolutely there is some difficulty experienced, but then the supply chain is not totally closed. So it's open. And so that being the situation, the issue is about remittances. The question is about that only. SWIFT is the communication system and remittances process flows kind of thing. Now, for last almost 2 months or 3 months, we have been in discussion with, because our government and RBI wants that there has to be repairable settlement transaction settlement arrangement. So the Russian banks had visited us when they have been in discussion with the various banks in India, including SBI and other public sector banks and private sector banks. We have been a part of that discussion team. So the process is on. Mostly it is thrust out. Only the regulators' approval is awaited. It should come any moment, because RBI is keen to find a way out for repairable settlement, transaction settlement. Similarly, IBA is also involved in that. And Russian delegation had a discussion with Government of India and RBI officials. So that being in the process, so we are awaiting only RBI's approval. But one fact is, I should make it clear, there is no alternative system of financial messaging except SWIFT right now. RBI has been very, very categorical that SWIFT will continue to be there. That's the only way of, messaging financial statements or financial messaging system. So the system will work out. That's not an issue, because RBI is there, and then once the repairable arrangement is there for Vostro account, I think that should facilitate the trade between India and Russia.
Okay, but sir, like even if we assume that all the mechanism for the payment system that also is in place, and as you said that there has been like some mechanism which has been found out, but still there is some sort of deficiency so far as the supply is concerned. But supposing, say, the rough diamond supply is restored, but there has been certain issues from the demand angle as well. So do we expect enough demand from the key consuming nations, especially US and all, and or there would be an increased supply which may lead to high inventory levels with the entities in the midstream?
You ask the question to me?
I'm asking to Mr. Raj Gopalan, sir, if you can throw some light on it.
Yeah, you see, if you go by the consumption of luxuries in this recent data that has been published, there has been an increase by the Americans. So a substantial portion of that is in the jewelry sector. So as of now, there are no indications that the demand will be coming down in America. Certainly, the indications are not there. Yes, China is one big question mark. It's a closed country. We all feel that the lockdown effect has been felt until now. The lockdown has been, it is getting slowly lifted And so it is quite possible that consumption may improve there, because Chinese marriages take place only with, diamond rings. So without that, Chinese marriages, engagements, they do not take place. So naturally, there the normal consumption that is there, in China, it has to resume. It will resume. So with things opening up, so it may not be, in the throwaway. Chinese don't use throwaway diamonds. They use normally diamonds which are kept as a store of value. So the consumption, which has come down, it is likely to pick up. That is the expectation of the industry as such, because after all, the population, they have to marry, they have to, do their normal, family rituals. So all these things will certainly involve the consumption of these diamonds to a certain extent. So we don't expect that the demand will be, yes, there will be a small sluggishness in demand. In the jewelry area, the sluggishness in demand will be there, but that demand will be mostly probably replaced by, when we come to the, the lab-made diamond sector, we
LGDs.
discuss about it. So I don't
But,
expect that in the 1 carat above area, and also in the area which is normally used, the diamonds that are used in diamonds and other family rituals, there will be any, reduction in demand.
But sir, do you expect any pressure on the margin because the rough diamond and the polished diamond prices has been all-time high in the recent past? So the margin impact, do you see the impact?
Yes, there will be a pressure on the margins. Certainly, I expect the pressure on the margins, and especially small players will find it difficult to meet that pressure on the margins. Their profitability will certainly be affected by our feeling. The bigger players will find it, they will be able to ride over it to a larger extent. But smaller players will find it difficult to, the bargaining will be too much, and they will find it very difficult to face that bargaining. And so, they have to go to the bigger players and ask them, you buy our diamonds and sell. So nevertheless, diamond is more or less a closed community, each one helping the other. So a person who is really, doing his business properly, he will face, what you call a reduction in margins, but he will not be obliterated totally. The people who are diverting those monies here and there and using diamond as a platform to do this, such people won't be able to survive anymore. Genuine manufacturers, they will be able to survive. With lower margins, they will be able to do their business, and that will go on. So I don't.
Sir, as we have seen, during the presentation, also we see some sort of greater demand from the LGD segment is concerned. So, in fact, we have also observed that many players in the industry have started focusing on LGD segment. So, what is your view on the opportunities available, and whether the facilities or the capital expenditure that the diamond processors have made in the natural diamond segment that can be utilized for the LGD segment as well, and any view on the profitability margin in the LGD segment, sir?
Cutting and polishing, it doesn't make there is no difference in cutting and polishing of an LGD or.
Okay, got it. So it can be
merely buying an LGD and cutting and polishing it is not going to give you much return. So people have to go in for, especially if you want to be in a middle segment, you have to manufacture the cut and polished diamonds. At least the CVD has to be manufactured. CVD techniques are now fairly well stabilized. It only requires a little bit of time for you to settle yourself and produce the right type of diamonds. That will take time. That will take time. But people will be able to settle. There are more than a dozen manufacturers who are doing very well in India. I am told that there are around 25 manufacturers who are producing cut and polished diamonds. All are in it. So the future of the jewelry industry, I see in cut and polished diamonds. in the LGD, the
LGD segment. Got it. So, Mr. Das, do you see any, new proposals coming in from the existing or the new players in the LGD segment? Any new entrants? What is your inputs on that?
all big players will go in for this LGD.
Yeah, and Mr. Das, from banking point of view, do you see any more proposals?
Thank you, Mr. Joyce. The fact is that all our major players who are into natural diamonds are also seriously now getting into this LGD. And our experience has been that these natural diamond players have been with us for decades. So we know the kind of business they do. So considering that their vintage and the current technological support which is required for manufacturing these LGDs, because they have already the setup for cutting and polishing. So it's only the manufacturing part of it. So for that initial investment in capital investment for the setting up of the unit, we see a lot of interest being expressed by these clients and then diamonders, and then we are always happy to be there with them in all their business ventures. So we also encourage them, and we have been taking their request and then considering their meeting their requirements as and when they come to us. And in fact, we encourage them in case of any kind of branching out up to LGD. We will always be there to support them. And in fact, we have some of the clients which have availed already.
So great to hear that. I think the momentum is now visible on the ground. That's
and
great.
In fact, I understand the State Bank of India also is having a policy approved.
Correct.
They are getting into this business as well.
So that's good that banking community is also very encouraging so far as this particular segment is concerned. So it's a signing ground for the CPD players also, that all the stakeholders are in the same page. Great, sir. Sir, we have received certain audience questions. So probably in the interest of time, let us move to that. There is one question. Probably this can be answered by Mr. Raj Gopalan. Currently, is there any shortage of rubs in the market, rub diamond in the market?
There is no shortage of rough diamond in the market. The only problem is, people are controlling their purchases. Because, because of the margins, the rough prices have gone up. So.
Right. So similar is the question. Another question probably. I think the similar answer is there, because the question is that whether the supply from Uldrasa is still continuing. I think we have answered during our panel discussion on that. One more question is from one of the banker in Ahmedabad. So he's asking that can you comment on the risk and the business opportunities in financing the CVD LGD units? So far as the capex and the working capital requirement is concerned, and any viability point of view, I think Mr. Das, you can throw some light on it.
Thank you. I have already explained. See, we know the vintage of the business, and we know the promoters' vintage as well. Considering that, as of now, we have not experienced any problem as far as the viability of the scheme and the product acceptance by the consumers. There is a huge market available because of the lesser price of the price compared to natural diamonds. So that being the state of this position, there is absolutely no reason to feel apprehensive about the viability and also the product acceptability and the pricing. And of late, what we have experienced is that the promoters or the diamonders who are getting into LGD, they have been doing great so far. So no bad experiences. So we will be happy to be there with them all through their journey. So there is absolutely no issue. I think that satisfies the questionnaire.
Okay, got it. Sir, one question is from the audience that considering the lack of homogeneity in the natural diamonds with no standard pricing base, so how are the banks relying on the valuation of the inventory for exposure into this particular sector?
This is addressed to Mr. Das, I believe.
Yeah. See, inventory valuation remains a real challenge in the industry. Let's accept that fact. But banks till now have been relying on management declaration and disclosures. Some cues from online portals such as Rappaport, Rappnet, etc. provide some clue. That's a fact. But professional valuation normally is a time-consuming and cost-consuming. It's not cost-effective, and it cannot be done so frequently.
Okay.
But when the valuation aspect is considered on the basis of the disclosures or declarations by the promoter, we exclusively depend on the integrity of the player in the industry. And that's what is best. And so far, so good, it has been running smooth. There are some bankers who are doing the stock valuation, but then that's a long-term process. Annually, once you can do, unlike in other industries where valuation can be done as frequently as possible.
So probably Indian corporates are yet to emerge so far as the best practices under the this particular issue is concerned.
Absolutely.
Got it. Sir, I think we can discuss a lot of issues because your expert inputs are really helpful. But I think we are coming to the end of this particular session. It's time constraints. So I think we had a very interesting session, and more importantly, we have got a lot of clear answers from the experts. So all in all, we believe that Indian cut and polished basically segment and the industry, after witnessing a significant robust growth during this particular last financial year, now some challenges are definitely there. So hence probably the collaborative efforts, including all the stakeholders, including the government and everything. So that is definitely going to be crucial. And on the other hand, the LGD segment is definitely glittering. So that will have some handsome growth. So thanks a lot for participating in this webinar. And we'll be back with more such interesting sessions in the coming days. Please do join us, the audience. And goodbye for now. Thank you.
Thank you, Mr. Yogesh and your team. Thank you, Rajagopalan sir.
Thank you.
Thank you, sir.
Thank you,
so
Mr.
much.
Das, and